Okay, perfect. Good morning, everyone. As promised, we're going to start 2 minutes past 9, which is now. Um, First of all, thank you for joining. As you might see by my background, it looks really nice. And the reason behind it is that I forgot about the webinar and I've booked my holidays. Nevertheless, Mo, which is a new analyst who started with us 2.5 months ago, worked on this presentation together with a few more people. I just wanted to highlight before we start the presentation is that we're doing this last webinar before our first forum that will be live in person in Boca Raton, Florida on November 9 and 10. First day is going to be focused on indexing and annuities, finishing with an award ceremony for the whole industry. And the second day focus more on the securitized products like structured products, preferred ETFs, and so on. The idea of the forum is to bring everyone together in the same place to discuss trends, new regulation, and developments in technology. So although I'm always thankful for all of you to join us today, I would even be much more thankful and happy if I could see you in person in less than 1 month. Okay, to find more information, you can always log in on our website, spintelligence.com. Okay, perfect. So let me start the presentation. I'm going to give you a bit of an overview on how structured products are fitting with alternatives, because I think as we've seen by the mergers and acquisitions on independent broker dealers, a lot of is happening, and as well with the development of the multi-asset platforms. Mo will also give you a focus on more what's happening outside the US, some European institutional numbers, which we believe are relevant, okay? And I think you can learn some of the things that are happening there. Then we will talk about the US market, how it's been the first 3 quarters. And as well, Mo will give you a bit of an analysis on the current portfolio of structured products currently live, and we'll give you a bit of macro outlook. Okay, so we've put this photo here about dominoes, and I'm sure if a lot of you played, I remember playing around with them when I was a kid with my friends, and I think the most interesting thing for us was not playing dominoes, was putting them all standing and just try to destroy everything. And why do we put these photos? Well, I think when we looked at what happened with COVID, it was actually something similar. What I mean is, although investors, financial media, and even some of us have been telling about how diversification important is, with COVID, diversification didn't matter, at least the diversification between bond and equities. They all went down, and I think that stuck with investors. And let me give you here a graph, which I think it explains. So only in the past 4 years, the correlation between the S&P 500 and 10 years US government bonds varied between plus 0.8 and minus 0.8, and that's incredible. Clearly, and I think it's something that it's stuck in people's mind, is that this diversification it doesn't work as people thought. And I think that's where structured products and other alternatives are actually getting much more demand and people looking at them. Actually, while I speak, you have a Q&A that is allowed, so you can always send us the questions. We will answer them at the end, but feel free to post them as you feel fit. Okay, and besides this correlation issue, I think we have the perfect macro environment for alternatives. One, interest rates are not what they used to be. You can see there from 2016. Although the last 2 to 3 months has been positive with this with increase on the slope, it's still far from the levels that people expected. Okay. Also, another interesting aspect is the VIX, the volatility. It came down quite a lot since COVID, but it's still at high levels compared with prior to COVID, which also explains a bit the fear on of investors on actually where to invest, and a bit afraid of equity markets. Then we also have the dividend yield, which was lower during COVID, as companies decided not to pay the dividends last year, and of course, with that dividend, it also affected a lot of the investment banks. And then we have then the last one, which is of course inflation, which everyone has been talking about. So we have here a couple of things. One, interest rates, very low. So fixed income are not providing the return that is necessary, and quite actually are providing negative real returns if you discount inflation. And then you have the equity markets where volatility is high and dividends are low. And this is taking a lot of the investors to look to alternatives, mostly to alternative investments, which a lot of advisors and distributors are putting structured products in. Why is that? Well, you can see here a study from a broker dealer that they're showing to clients. So yeah, telling that alternatives can provide a return which is market direction agnostic and constrained compared with the normal equity markets. And I think that is where, and all asset classes, and I think this is where now a lot of the distributors are telling investors that structured products actually fit in this alternative bucket, and that it can provide a diversification to a client's portfolio. And you can see on the right the table with the correlation between 97 and 2017, all the different asset classes, and you can see that US bonds minus 0.05, managed futures minus 0.14, and so on, and market neutral 0.32. Now, if you don't believe only in this, we actually gathered two other examples. One is a research done by the Rubini Thought Lab back in 2020, and they basically asked the buy side to forecast it now and in 2021 percentage of different asset classes. And what we found out is that there is a considerable growth on alternative investment firms, okay, like private equity firms, but also structured products. And you can see there are some quotes from 87% of Connection Capital investors will invest in alternative investment funds, okay. And you can see there another quote saying, our client base is already well diversified into alternatives, with over a third now allocating a fifth or more of their portfolio to alternatives. So 20% of clients' portfolio. And I think this is where some of the growth within structured products, but also globally, is coming from. And then we also found out this really interesting article. If you're curious, please ask us. We can send you the link. It's actually an investigation on Pictet for more of the US only focused people on this group. Pictet is a 215-year-old private wealth firm. So they have billions of assets, and actually they are now struggling. They have key employees leaving, putting billions in assets under management at stake. At the heart of this, it's actually a cultural clash on the products that they offer. They found out that a lot of the customers that are bringing revenue actually are costing too much due to the costs of Pictet to manage funds and so on. And it seems that a lot of the new staff wants to use more alternative investments, and there's been a big talk about structured products. The conclusion is that actually for Pictet to become relevant versus other private banks like UBS, Credit Suisse, other private banks who are based in the US as well as in Asia, structured products are the next step to growth because first, although they are more risky, they attract a new and younger clientele. And we thought this was actually a quite interesting article because it's not every day that it comes on an international newspaper saying how a private bank needs to sell structured products. So on this, I'm going to give the word to Mo, who will give a bit of overview on our European and US numbers. So Mo, you go.
I cannot apparently start my video for a reason, but okay. Thank you, Tiago. All right, so before we jump into analyzing the US market, I will begin by giving you guys a brief overview of the European retail and institutional market. The sales volumes of structured products in Europe is basically estimated to grow between 7 and 11%. But the question is, what jurisdictions does that growth come from? And if we take a look at this graph right here in front of us, we can highlight that huge growth in the French and the Euro MTF markets. For instance, in the first half of this year, the sales volumes of the Euro MTF already surpassed the total sales volumes of 2020. And it's also estimated to grow by a total of 20% by the end of this year. And on the other hand, the sales volumes in France crossed the halfway mark of 2020 by a long shot. I mean, sales volumes in the first half of last year were around 10 billion, while this year's around 13.5. All right, when it comes to the retail market, if we look at the first graph to the left, it seems like investors took a liking to income products that basically they pay them coupons. And that is used to specifically what Tiago mentioned before regarding the lower interest rates. And in the graph below it, the product subtype graph, we can notice that the Barrier Digital and the Barrier Phoenix products constitute over 60% of the market share in 2021 year to date. Now, both of these are income products. Also, it's important to note that because investors are worried about a market correction, we saw a considerable decrease in the average barrier in the European structured products since the beginning of September. And that's the graph to the left below. All right, now let's have a quick look at the European institutional market. This graph right here compares the growth of product subtypes along with what type they belong to, both in the first half of 2020 and the first half of 2021. There was an increase in protected participation products and in the participation subtypes. As for the income products, we can notice the growth in Barrier Phoenix and Barrier Digital subtypes and a decrease in the reverse convertibles. All right, well, enough with Europe, right? Let's talk a little bit about the US now. In the US, sales volumes increased by a whopping 23% in Q3. I mean, this increase is the result of a rise in rollover amount, which is another term of saying that expiring products are being reinvested in newly issued structured products. Now, we cannot say that this year's Q3 is better than Q1 or Q2 of this year. But if we compare it to the sales volumes of previous years, we can say that the interest in structured products is growing exponentially. And to be more specific, let's take a look at the issuer's legal table. All right, it seems like Barclays, who held the highest market share in Q2, has passed the hat on to Goldman in Q3. But that doesn't necessarily mean that they had the highest year-on-year growth. In fact, that title goes to Jeffries with 770% year-on-year growth. And Jeffries has been out of the market for a while, so we can safely say that they are coming back strong. Then we have BMO with 130% year-on-year growth, followed by Societe Generale with 53%. In contrast, the highest negative growth goes to Credit Suisse with a minus 41%. And it looks like they're still affected by the Archegos blowout. But what about payoffs? All right, let's see. First things first, income products continue to grow at the expense of growth products, which means that the US investors share the same fears of European investors when it comes to lower interest rates. And because of these lower interest rates, along with an all-time high in the equity market, autocalls are attracting investors. Well, autocalls actually grew by around 27% year-on-year in Q3. In particular, investors are interested in both the Phoenix and digital structures. Just look at the barrier digital year-on-year growth in the table below. It's around 132%. And if you combine the market share of the barrier Phoenixes with and without autocall, you'll get a 48% market share for barrier Phoenix products. All right, let's dive a little deeper into the portfolio and look at the underlyings. The top 3 underlyings in sales volumes are the S&P 500, the Nasdaq 100, and the Russell 2000. And although equity indices are the most popular underlyings, exposure might be far riskier than we think. And I will explain my reasoning, but briefly. First, look at the dominating worst off type and the market share. Almost 51% of underlying types are worst offs. Now, if we look at the current underlyings exposure in the next page, look at this. A high number of structured products is linked to the Russell 2000 among other underlyings, and these are more volatile than the S&P 500 or the Nasdaq 100. Therefore, the assumption is that the stability of the S&P 500 and the Nasdaq could be offset by the volatility of other underlyings that might perform worse. And if they perform worse, then that's going to impact the worst off products, which, as we just said, hold 51% of the market share. But then again, I mean, if we look at the current level of outstanding structured products, more than 80% are in the money, which means that even if there was a market correction, we still have a certain cushion to rely on. All right, I'll give back the word to Tiago. Thank you, guys.
All right, perfect. Thank you, Mo. Look, I think we wanted to make this short and sweet because I know we all have a big day ahead of you. So we wanted to give a bit of a forward-looking picture and what could happen. And I think what we wanted to focus is one on this graph here, where we actually said that, looking at the old worst offs, there is a lot of money linked to the Russell 2000, but as of now, more than 80% of all products are in the money, okay? And a lot of them, as you said, 37% are, more than 25% in the money. So it's a quite comfortable place to be at, okay? But still, there is a concern about if the markets will have a correction soon rather than later. So I wanted to look back at the average coupons versus the knock-in barrier in the US structured products market, as well the recent pickup on volatility. We also saw during the Q3 that there was a shift from the barrier Phoenix, that basically autocall that provides a more frequent coupon than the call barrier, to the barrier digital, which basically is when the coupon is paid on together with the call date. And I think what we saw, it was an increase on the barrier digital without a frequent coupon, because pricing wasn't that favorable for more income products. Now, as volatility slightly increased compared with actually back to end of March volatility, it seems that the coupons could actually increase. We've looked at the average coupons, and you could see there from the graph on the left, in 2020 we're around 11% for all products offered, and then it's been around that. But in October, for the products that are currently on the calendar offering, it went down to 9%. And we also saw an increase on the average barrier from 67, 68 to 69%. So I think what we will see with more custom deals and with potentially more the November products, I think we will see a decrease on the barrier level or an increase on the coupon. I believe that I think if people are okay to accept a 8-9% coupon, I think issuers will start looking at decreasing the average barrier is to offer some more protection to investors in case on a market correction. Okay, and I think besides that is we also seen an increase is on the best of features on the barrier. Is basically you get the coupon, you get the call observation on the worst of, but at maturity, your capital is only at risk if the best of the underlyings is actually down. We've seen a couple of the issuers doing that, JP Morgan and a few other, and I think that's becoming slightly more popular as people are expecting a market correction. So yeah, looking forward, I think it's going to be very interesting end of year. As Mo mentioned, a lot of the products are in the money. They will probably mature early, although there is less amounts rolling over in the next quarter. But with a higher volatility and the slight increase on interest rates, I think it's probably a good momentum, and we probably will finish the year in another record year for the structured products in the US. So thank you. We're now going to open to questions. So I'm going to look at the chat just to see if there is any. So please send it to us. And while we wait for the answers, we actually have something to announce. Second. Apologies. We are very thankful that we are actually able to a second. We are able to announce today that we're going to have Professor Robert Merton from the School of Management at MIT. And for those who don't remember, that won a Nobel Prize for their pricing options theory, that it's been used in structured products. That is going to speak at our event on November 9 on an interview that the name is called From Options Pricing to Defined Outcome Strategies. It's going to be an interview done by Trea Di Pietro, Chief Strategy Officer at Market Synergy Group. And I think the goal is actually going to ask Professor Robert Merton how he thinks about how, from his theories and other professors' theories, how, structured products and annuities, FIAs developed, and, what he thinks about it. I think we briefly spoke with him, and he's actually quite excited to tell the practitioners what he thinks about our industry. Okay, so a couple of questions. I know, will this deck be available after the presentation? Yes, we're going to share the deck with everyone who joined us today. So still waiting for more questions. Okay. Okay, giving some. Do you see structured notes market share getting dinged by indexed annuities? Actually, no. Securitized structured products are actually growing faster than annuities, which was quite interesting. I think on the last webinar, we focused on one of that subjects. And what we saw is that there is some money that is on market link CDs, that products that are maturing, and that small amount is going to fixed index annuities because the capital protected long term as market link CDs. And at the moment, issuers are not offering that many market link CDs. So that's the only part of the market we see going to insurance. But I would say securitized products are growing faster than annuities. And I think the reason behind it is, annuities are struggling to offer protection, which is their main focus. Like, structured products, these structured capital products disappeared. And while the natural structured products with the more riskier are actually looking much more attractive compared with fixed income alternatives. Okay, we've got some people thanking for the insightful presentation. Now, thank you for joining us. And 1 second. Okay.
There are 2 questions in the Q&A box.
I can see now. Are any of structured products you looked into based on the VIX index? We've seen them in the past. Currently, there isn't much, not on the structured notes. There are some on the ETNs, so the exchange traded notes, but they have not been that popular. Second question, do you expect to see an impact for structured products if there are changes in tax regulation, especially capital gains or changes to investments allowed in retirement accounts? Yes, correct. It's a big topic. And I would also not forget about DOL. Okay, I think with the new administration, that could come back. I think there has been discussions. So we're actually getting a team of lawyers to speak at our event about it. But I would say that yes, there will be an impact, especially if capital gains are versus retirement products such as annuities. Although we don't think that is going to happen in the short term, as the administration still didn't initiate the conversation about it. Okay, we have a couple of more questions. Would you suggest advisors to look into the snowball review notes as the CD alternatives? To be honest, I think at the moment, it's a difficult question. It depends of, does the investor willing to accept a high risk? I would personally, and again, I'll tell you, this is my own view. I think people should have much more of their investments attached to more structured products and mainly products with barriers. Okay, because I think the risk of barriers is quite extreme low. So I would say yes. Although, of course, you need to understand if the investor's risk profile is suitable for those products, as usually, CDs are really almost risk-free investments, while structured notes are not. Another question, due to low interest rate environment, the issue amount is increasing. More people want to get loan. After the Fed raises interest rates, do you think it's going to affect the issue amount of securitized products? Definitely. I think it's all about the extra return you give to clients. And at the moment, structured products look amazingly well in every single jurisdiction: Europe, Asia, US. When you have a 1% yield for 5 years, it's not attractive at all. So if interest rates started to increase, it will definitely decrease the total amount invested in structured products. Okay, we have 4 more questions. Can you say a few words of structured ETF market versus classic notes? I think there are, I'll conclude with one benefit and one disadvantage. I think the benefit is being listed, okay, and being more transparent on the secondary market, right? Because if you buy a note, usually you only get the price from the issuer, okay? And I think on buffered ETFs, because it's listed, you have much more people buying and selling, which is a big advantage. The disadvantage, and I think this is why I think the classic structured notes are not going to be replaced, is the funding level. When you're buying a buffered ETF, what they are doing is, then they're not investing on issuers' notes. They're buying the options, the listed options, which means that you don't get the extra funding from the banks. So if you compare 1-to-1, structured ETFs should have a lower coupon, okay, or lower performance than compared with a classic structured notes, but in the advantage is the liquidity. And the other thing, because of the liquidity, it's much easier to sell as a distributor or as an advisor than with the structured notes that have special rules. So I would also highlight that. Okay. I know this is a topic of your conference, but will there be further consolidation among the wholesalers with platforms or other shops? Yes, we got the panel with top 3 CEOs of some of the broker dealers or the wholesalers. So we have Spirex CEO, AAM CEO, and Axio that was bought. I think we saw a lot. We saw Axio being bought by Capital. We saw Capital merging with a fintech, becoming Spirex, and I think potentially there will be consolidations to have. And I think we also need to think is the multi-share platforms like Halo, Simon, and Luma, who are on the RIA channel becoming brokers or distributors. So depending on the technology, depending on if they're only selling structured products, I think there will be more consolidations. At a certain point, the market can't grow enough to have so many wholesalers. But again, that's my personal view. I know some of the brokers and some of the platforms especially have a different opinion. Okay, I believe we answered all questions. Okay, perfect. Look, thanks everyone for attending. Please stay in touch with us about our conference. We really hope to see you there. Yeah, we're really excited to have Professor Merton joining us. So thank you all and have a nice day. And thank you, Mo, for participating.
Thank you. Have a good day, everyone.